Yeah.
Right. Good afternoon, everyone. Thank you for joining us today. We know it's a public holiday, but we have a fantastic speaker lined up, which will be worth your time spending learning during this public holiday. So I'm Faros Nada. I'm the ED of Global Compact Network Malaysia. We are the local network of the United Nations Global Compact, which is the world's largest movement on corporate sustainability. So today, for a very exciting session, which we have co-organized with Nottingham University Business School, we have Honorary Professor Tim Gosher with us to share his insights on a very important topic, especially during crisis recovery. Now, before we start off, I'd just like to do a brief introduction to the digital tools that we'll be using to make this a more seamless experience for everyone. First and foremost, house rules is we will ask everyone to mute themselves and please turn off your video cameras. And for Q&A, we apologize upfront. We seem to have a little bit glitch in the chat function of the Teams. So what we are doing is we are going to use Menti for the ask a question options. So how are you going to use this? If you go to Shawin, can you just show that? Okay. So please log in your browsers, go to menti.com and type in 522473. This will direct you to our Q&A and also polling room at the end of it. So it's important for you to log into this menti.com 522473. So what happens is once you have once you have submitted your code, you will come to this ask a question screen. Click ask a question, type any questions that you want. Click submit. Your question should appear. And if you like a particular question, you can click like. So the idea is the most upvoted questions will be asked during the Q&A session. So please feel free to ask as many questions as you like. We will be monitoring on this part. So without further ado, let me please briefly introduce a good friend, Dr. Mohan. So Dr. Mohan is an associate professor of strategic management and acting dean at the Nottingham University Business Schools in the University of Nottingham, Malaysia campus. So he will be our moderator for the day. Dr. Mohan, over to you.
Thank you, Faroz. A small correction. I'm no more the acting dean. I'm now the director for research. But nevertheless, good afternoon, everybody. For all the Buddhists, good wishes for the Vesak Day or Buddha Purnima, and thank you for joining us. I'm going to try to take just a minute and walk through one of the most illustrious colleagues we have, Tim Ghosh, the speaker for today. He's the founder and CEO of Dolma Impact Fund. I don't want to talk what is impact because we are going to leave it to Tim to tell us that on impact investments. And he's now become a colleague as an honorary professor for sustainable business with the business school in Malaysia. It's been 5 years now. We've been working together. He comes and engages with us in research and also in teaching. He has a background in private equity, energy, and technology. And some of you have heard he's also a pianist now. But let's come back to his day job. As a private equity man, he's been in the mainstream, but he's also now come into impact investments and also ESG related issues. And he set up the Dolma Impact Fund, which is the first international private equity fund in Nepal. And this is the reason why we've requested him. As somebody who knows how to get ESG or impact funds into the developing world and also supporting businesses there, we thought it would be very relevant for Malaysia, ASEAN countries, or developing countries to see how companies could attract investment funds. And even if you're not a finance person, this would help in developing proposals to funding agencies, grant agencies, those that are looking for good impact, social and environmental impact. Tim also is the chairman for Dolma Foundation, a British non-profit organization that works in the education field post-Nepal earthquake. He's also working with the UK government's international development DFID entity on the Dolma Himalayan Climate Fund. So whether it's climate change issues that is the environment, or social issues in terms of education and business issues, we have the right person to talk and later ask questions too. Right? Thank you very much to all who've joined again. And Tim, I hand over to you now.
Thank you, Dr. Mohan. I will say good afternoon to everybody. Most of you are in Asia, Malaysia, some in Nepal, I think Hong Kong, other places. I am talking to you from my home in Essex, just near London. We are in lockdown. I think Malaysia is on the way out of lockdown, but I hope you're all safe and well. I wish you all a happy Vesak Day, very much celebrated in Nepal, the country we invest most in, as the, I think the birthday and the commemoration of Nirvana. I can't offer Nirvana today, but hopefully I can offer some small enlightenment. I'm going to share my slides. Just a quick, if everybody could put mute on, that would be great. I have small children too who may threaten to come in. I want to just check that my slides can be seen. Dr. Mohan?
And your slide was on earlier, but it went off.
Just try again, please. Yes,
Okay.
we are on now.
Yes, sir. Yep.
Okay. Good. Now, please do ask questions. It doesn't quite have the ambience of a University of Nottingham lecture hall, but the questions will help. I'm just going to put that in presentation. So what I thought we would cover today is really the definitions of ESG and impact and the types of impact investment. Who are the investors? What forces are driving that investment? I'm going to give two case studies from some of the investments we've made in companies. And of course, we couldn't talk about impact investment without mentioning coronavirus. I'm going to try to finish by 9:10, so in about half an hour, to give plenty of time for questions and a poll at the end. But I'll start by introducing what we do at the Dolma Group. In 2003, I founded the Dolma Foundation, which is a non-profit, actually giving scholarships for education mostly. We've also done, if you like, impact investment in ecotourism. But in 2014, we launched and raised the first private equity fund for Nepal with institutional investors from Europe. And I'll be talking more about the impact strategies of Dolma Impact Fund, as well as Dolma Himalayan Energy. Okay, I wanted to start with a definition because the terms of ESG, impact investment, social entrepreneurship, they're often confused and they are indeed overlapping. But I'll tell you the way most institutional investors look at this. I won't read this out, but ESG is a governance policy in a company. It covers obviously environmental and social issues, and so at Dolma, for example, we have a ESG policy for every company. We do an environmental and social action plan. We have an environmental and social management system for every company, which tracks all of the risks, mitigations, and actions to do with environmental and social governance. I wanted to mention, though, that ESG, in order for it to work, has to go beyond policy. It's really a culture, and it's very much synergistic with governance in general, is something we've learned. If we find a company as an investor which is poor on ESG, it's very likely that we find them poor on legal governance, board governance, financial governance, etc. And so I think our experience is that this is not some sort of add-on to a company's policy. This is really core. It's the way you think about business. It's the way you think about quality assurance. The main standard we use for, there are lots of standards out there for ESG. The main standard we use is the IFC performance standards. IFC are the private sector arm of the World Bank. And they have 8 issues. You can see here how we break down some of these issues. In places like Nepal and indeed anywhere, labour and working conditions are a big deal. What you find is that these performance standards go usually over and above the local law. So you find yourself doing that. Why do you do that? You do that for ultimately commercial reasons. The reason is these are risks. If you ignore labour, if you exploit your workers, if you screw people on the land acquisition price, if you ignore biodiversity, it will come back to bite you. And so really we see ESG as something in the core of our being, but also very much a commercial risk mitigation strategy. I should mention that on this call we have Dolma's Head of Impact and Environmental and Social Governance, Sandeep Shrestha. And we're going to go through lots of acronyms in a minute. He is available during the questions if you'd like to address any questions to him on how to measure these things, how to implement these things. Impact investment is separate in my mind from ESG. Impact investment, if you like, ESG is risk mitigation and a core of a company's mission. Impact investment is looking over and above risk management, measuring and tracking the social and environmental benefits. So if you like, ESG is trying to do no evil, impact investment is trying to do good. Within impact investment, there are various investment strategies, and I like to talk about this spectrum. All impact investment aims to create a social and environmental benefit alongside a financial return. And therefore, that financial return could be zero, or it could be whatever the market return is for the risk of that investment. And you can see here, obviously, if the investment intention, obviously some commercial investments are below zero, but if the investment in the end, if the investment intention is to be less than zero, that's called aid, not impact investment. But in some cases, like Dolma, some of the funds mentioned here, they're very much what's called finance first impact funds. We at Dolma Impact Fund see our objective as developing the market in Nepal by creating a track record of attractive returns. In a country which has very little foreign direct investment, we think the ultimate impact we can have is to create attractive financial returns which encourages more financial investment in the country. But there are other strategies. So we are focused on a market rate of return, and therefore we look at that alongside the environmental and social benefit. We do not, for example, subsidize. And so you could see a scenario where, for example, we own a pharmaceutical factory, and it may be socially fantastic to give away medicine in certain cases. But if that is done for our company and it artificially lowers the return, all we would be doing is lowering the perceived return in a country like Nepal, thus attracting less investment. That's not to say that we can't partner with charities or NGOs who can help to give away that medicine. But in other cases, there are investors like Acumen Fund, for example, which have largely a donor base as opposed to a private sector base of investors. And in those cases, they will subsidize returns. And this is especially relevant in more developed markets You see in the UK, impact investors looking at really solving social problems, really crossing over with governmental, almost third sector. You see increasingly a lot of charities, Oxfam and their impact fund. Really, they'd be happy if they get a very small return and achieve certain social or environmental objectives. So you'd call those impact first investors. You can see here at the bottom of the slide some of the standard setting bodies, which I'm also going to talk about on the next slide. This is an extract from our latest impact report. It shows how we measure impact and the standards that we follow. You can see there an alphabet soup of standards. Some of them are our investors, and we have to follow those standards, of course. IFC performance standards I've mentioned. Gender is an increasingly important issue, gender equality. I'm going to talk about that specifically in a second. One of the main standard setting bodies are GIN, which I encourage you to look at. Recently, we have, so we do a separate ESG report every year based on the IFC performance standards, and we do a separate impact report. Recently, we switched to aligning that reporting with the SDGs, which I encourage everybody to do. And here we can see some examples of the 5 key SDGs that Dolma Impact Fund is focused on. Now, there are many ways that you can measure SDGs. It's quite a flexible framework. You can see here that we invest in renewable energy, and so we're creating nearly 7,000 gigawatt hours. The projects are currently under construction. That's why there's nothing in 2019, but they'll start coming online this year. We've also generated a lot of jobs. You can see here nearly 4,000 jobs in Nepal through as direct jobs created. That figure is over 5,000. We also have through our portfolio investments in Kenya, the Dominican Republic, the US, the UK, and that's a significant number. We've also implemented gender equality policies. Now, for those of you talking to Western, perhaps Australian, European, American investors, gender equality is an increasingly important topic in impact investment. We stop short of quotas. We don't say companies have to have a certain number of females on the board. What we do, and it's amazing what can be achieved, is we implement gender equality policies, anti-discrimination policies, not just for gender, of course. And it's amazing to see that, in fact, one of our great statistics not here is that 92% of our female employees in our portfolio are skilled workers. And so we see a lot of engineers, a lot of computer programmers, etc. in our portfolio. Another interesting thing we implemented is a way of measuring lifetime impact per million US dollars. And that gives a quantitative measure for, obviously, as a private equity fund, our investors, our limited partners, can see the financial returns. That's done every quarter and in our annual report. But what we're trying to bring out here is what return are you getting beyond that on these SDG metrics? And that is what's listed in the last column. Coming back to something a little more theoretical, it's very interesting. Back in the, I can't remember when, 60s, 70s, when Milton Friedman came up with the groundbreaking theory of shareholder theory, which stated that the job of a business to maximize its positive impact on society was to purely focus on shareholder value. Now, the world has moved on a lot since then, and we've seen what can happen when there is perhaps an obsessive focus on shareholder value. What happens is the garment factory collapse in Bangladesh, the financial crisis of 2007 to 2009, the oil spills in the Mexican Gulf, etc., etc. You can see what happens when shareholder value starts to bleed into greed. And it's very interesting to compare Friedman's doctrine with the UK Companies Act. This is the latest version. And I would point out here that it doesn't mention the word shareholder. It talks about members. A director must promote the success of a company for the benefit of its members, and it mentions employees, suppliers, customers, the community, and the environment, all as stakeholders. I want to point out that I believe that Milton Friedman's theory and the evolution of capitalism are actually consistent. Friedman's approach, his objective was to benefit society. I think what we've found out is that all of these things, by focusing on a broader set of stakeholders, actually you are promoting shareholder value. If you do not focus on employees, society, environment, customers, etc., you are simply taking a risk. You are taking an unnecessary risk. And so the balance of modern business and modern capitalism is indeed, as Friedman suggested, to create shareholder value. And you destroy shareholder value by ignoring the broader set of stakeholders. And I think this is the basic theory that is evolving in business today. I'm going to talk about the landscape of investors. Who is investing in impact? Who are the, if you had a company and you wanted to raise money, who is investing in impact? Foundations. You will find foundations that have more of a perhaps impact first policy. Family offices, high net worth individuals, corporations through their CSR budget. I want to stop there and just define CSR as well, because it's another slightly overlapping term. CSR, broadly speaking, is what a corporation does with its profits for social and environmental good. It is not, as impact investment is, generating benefits for society and the environment through doing its core business. But corporations have CSR budgets. Development finance institutions, most Western countries have them. They are effectively sovereign wealth funds focused on developing markets. Now, Malaysia is probably too wealthy for development finance institutions. They're looking at poorer markets, India, Nepal. A lot of our investors are development finance institutions, FMO from the Netherlands. Other examples are CDC from the UK, IFC itself, the private sector investment arm of the World Bank would be considered a DFI. There is an increasing number of private sector institutional investors which have started funds. Could I just ask everyone again to put on mute, because I am getting some background noise. Thank you. What we've seen recently is a trend. AXA, one of the world's biggest insurance companies, Allianz, the Rise Fund is a very high-profile fund, co-founded by Bono. It was set up by TPG, which is one of the world's largest private equity fund managers. So over the last, I'd say, 3 years, we have seen most of the large pension funds and insurance funds launch impact arms. Now, this creates a really interesting dilemma and opportunity. Of course, pension funds cannot do impact first strategies. They are managing your pension. Would you want them to invest for a 0% return? Probably not. Would you want them to invest in highly risky, perhaps a Nepal investment that could offer a 30% IRR, but is also very risky and could be worth nothing? Possibly not. And so these private sector institutions, which manage most of the world's money, Allianz, the German insurance company, manages $3 trillion, for example. They have to abide by a fiduciary duty to their policyholders to invest their money for a balanced risk return. They cannot take too many risks. They cannot target 1% return unless it's a sovereign bond, perhaps. This moves me on to, This moves me on to what is driving impact capital. Obviously, there are regulations coming out of the UN, or filtering down from the UN, the COP meetings. But one of the biggest things that's driving private sector impact investment is actually returns. And by impact investment here, I mean more development in poorer countries. And in a sense, that includes mainstream emerging markets like Malaysia. The reason for that is interest rates have been low since the financial crisis. Nobody thought that 12 years on, we would still be at close to zero interest rates. With coronavirus, that is set to continue for a number of years. What that means is that the biggest managers of money, let's say life insurance companies, they have promised, they know they have to pay out a certain amount in 20 years' time, say, on a life insurance policy. And their objective to meet that liability was to invest in securities that give a certain rate of return. So they may have thought that the German Bund or the US Treasury safe securities would have given 2% over 10, 20 years. In fact, as you can see now, they are giving, in some cases, negative interest rates. And so these private sector investors need to generate more return. And that is pushing them into riskier investments, not necessarily impact investments, but certainly taking more risk. That means going to emerging markets, so-called frontier markets, and taking more risk. So we're seeing this pressure on the world's largest investors. There's also a big push from philanthropists. You can see the major Bill and Melinda Gates Foundation, Dell Foundation, Rockefeller Foundation, all involving in philanthropy, and of course the major aid organizations. And also there's a big push from shareholders, policyholders, and the public. So you see the big funds starting. The first step is we're not going to invest in oil and coal. Now it's moving into more positive impact strategies. So these are some of the major drivers as to why the availability of capital for impact has grown so much. I'm going to quickly cover two specific examples of our impact investment. And I'd like to say first that what binds to me successful impact strategies is a mission. Is a mission that all of the employees, the country, the society involved can get behind, so that you can bind people to that mission. If you can create that kind of movement, if you like, the financing will usually flow. Of course, you have to have a good business plan with good returns. In this case, Dolma Himalayan Energy is something that we worked first with DFID, the British government, who provided a grant. The mission is to stop the Himalayan glaciers melting. It's no less ambitious than that. Now, that may sound very, very ambitious, and perhaps it is, but here is the situation in the Himalayas. The Himalayan glaciers are the third largest store of frozen water on Earth, sometimes called the third pole. They are melting fast. About 30% of their mass has been lost over the last few decades. And unless things change, 2/3 of that mass will be lost by 2100. The reason for the glacial melt is not only global warming. This map you can see is a map of black carbon, more commonly known as soot. And that soot rises from the plains from the south of the Himalayas, and it's caused by coal-fired power, people burning fires. In Nepal, 75% of primary energy is created by burning wood. It comes from poor exhausts. It comes from polluting factories. This is reversible. It's reversible if we can roll out renewable energy extremely rapidly. And of course, with the technologies of solar and battery, which we're using, we can do that. It's worth mentioning the social and environmental catastrophe which is already happening. Immediately to the south of the Himalayas, with Nepal bordering Indian states of India and Bangladesh, that comprises 600 million people, which is the densest pocket of extreme poverty on Earth. A lot of people think sub-Saharan Africa, but actually it's not. It's Bihar, Uttar Pradesh, Nepal, Bangladesh. They are immediately at risk of flooding. 28% of them live in extreme poverty compared to the global average for South Asia. So this is a very dense pocket of vulnerable people. And because of the Himalayan melt, they are suffering. And you can see how they suffer here. You can see how the floods spread out from the region. You can see me there on one of our Dolma Foundation trips to give emergency relief after a village was completely wiped out in an instant from a landslide, which are increasingly common. And we wanted to do something about that. So we launched Dolma Himalayan Energy. We got 2 private sector infrastructure investors after DFID. They are Infraco Asia out of Singapore and Climate Investor One, a private equity fund out of the Netherlands. We are developing large-scale 150 megawatt in phase 1 solar plants, but solar plants alone do not help poor countries because they're very intermittent. The grids are weak, and if you put intermittent power, every time a cloud goes over, the power drops, it will crash the grid. Also, it doesn't generate power when you need it the most. When it's needed, of course, is in the evening peak, when the sun typically has gone down. So we've seen the cost of lithium-ion batteries drop, especially as these gigafactories are produced, primarily driven by electric vehicle production. And if you combine batteries with solar, you can manage the generation, you can shift it to that peak. And that is what we are developing throughout the Himalayas, initially in Nepal. My second example is impact investment in cloud and AI. We've invested in 2 companies in this space, Fuse Machines, which trains students in Nepal who have perhaps a computer science degree, but are not ready to work in the latest AI software development. We train them, we put them on projects remotely, mostly in American leading edge companies. But Fuse Machines, I say we because I sit on the board, Fuse Machines also has an online learning platform. And their mission, I talked about the importance of having a mission, is to democratize AI. Cloud Factory, another mission-driven company, provides data management services for AI companies and machine learning. This is the concept of big data. For example, they will work for self-driving car companies, tagging frames of videos for obstacles. What can the algorithms recognize? They would work with insurance companies, tagging and managing huge data sets to feed into AI algorithms. This work, while Fuse Machines hires high-end software developers, Cloud Factory has some high-end software developers, but the majority of their employees are so-called cloud workers. They can work from home. In fact, they're definitely working from home at the moment. And it's fairly low skill. It means it's available to many people. So here what we've seen is the whole spectrum, and these companies together I think, have around 2,500, 3,000 employees. What we're seeing with the rise of the combination of the cloud, artificial intelligence, and computing processing power is often called the fourth industrial revolution. And unlike previous industrial revolutions, there is no need for the workers to be close to the means of production. In other words, in the first two industrial revolutions, of course, Britain started with its factories, the workers nearby got the jobs, developed the skills. The whole ecosystem was close to where those fixed assets were. With AI and the cloud, it really doesn't matter where those workers are. It doesn't matter if they're in Silicon Valley or Kathmandu. And so our investments are building on that. Cloud Factory was particularly good. Sometimes people look at impact investment as a separate thing from mainstream finance. I see it very much as part of mainstream finance. We recently got a round of investment from mainstream multi-billion-dollar venture capitalists in the US. And if I think back to a few years ago when we invested, we had the Rockefeller Foundation with a soft loan. We had Dolma, some other investors. And last year we managed to raise $65 million at a $100 million valuation for Cloud Factory, very much thanks to the extreme talent of the management team. And so this was a story, almost the ultimate impact story. Impact isn't only about little companies that stay small and have a great mission. Impact should be about ambition. It should be about scale. It should be about commerce, but with those kind of core missions embedded and measured. I am pretty much out of time, but again, I couldn't do this lecture without talking about COVID. Dolma Impact Fund is bravely in the market and raising a second fund. And we've just been through a due diligence process, and it's very clear where the opportunities lie. A lot of people are taking a defensive strategy, for which I would say, oh my goodness, my company's running out of money, please can I get a grant? And that is perhaps necessary, but we're very much taking the offensive or perhaps positive strategy. We're looking to invest in the businesses and sectors which will boom because of coronavirus. Those are, of course, tech, when it comes to telecommunications, fintech, health tech, which can leapfrog some of the physical infrastructure, especially in poorer countries. We're looking at healthcare, obviously hospitals, kidney care clinics. The second category we're looking at are those which are likely to bounce back very quickly. Education, agriculture, manufacturing. It probably doesn't include airlines, oil companies. I think there are some sectors which will suffer for the long term. But if you are looking for money, try to take that positive, offensive strategy. There is no better time to invest than to be countercyclical. You want the cash during a crisis. Cash is king. And if you look at this V-curve sectors, one of the most important things you can do as an investor is save jobs, because these companies will bounce back. I'm pretty much done. My sort of closing comments would be how to position your company for international investment. I'm very aware that some people in perhaps Malaysia going for European investment can be overwhelmed by the amount of compliance, all these ESG policies and impact metrics and everything else. But they are a force for good. And I think if you build impact investment at the core of your strategy and not just write down the policies, but you live and breathe the meaning behind those policies, you will be very well placed to raise money for your business. I'd also like to mention one of the unique competitive advantages of Malaysia is Islamic finance. I'm not an expert in Islamic finance, but I've always found a very close synergy between Islamic finance and impact investment. And I think tapping the Islamic finance market is really almost the same as an impact investment strategy. It is 11 minutes past 9. I promised to finish at 10 minutes past 9. I will therefore say thank you for listening and open for Q&A.
Brilliant, Tim. Thank you. And the last statement is particularly impactful. The Islamic financial institutions here have indeed started talking about merging with ESG kind of issues and adding the religious side of issues to it also. There are already questions, Tim. And by the way, for everybody, after the Q&A session, we'll try to end this a few minutes before 4:30 to run a poll on some of the issues we are interested in from the audience. The first question, Tim, if you're ready. One of the participants would like to know how best can we balance Asian or ASEAN sustainability realities with Western ESG or a Western impact investor expectations, something which you started ending the session with.
That's very good. If you think ASEAN expectations have a mismatch to, say, European investors, think about Nepalese companies. There is an enormous difference in the understanding of health and safety, of gender policy, etc. And it's our job as a private equity fund to bridge that gap. I would say that in some cases there is an element of decisions on policies being made in European capitals which don't always apply. And we have seen that. But largely, when you get into it, when you actually understand what's behind those, sure, some of them are difficult. And I'll give two examples in a second. But largely, we have found over the last many years that working closely with our investors and buying into the essence of these policies, they do become clear. One example is we have accidents on our construction site. We're building hydropower plants, we're blasting tunnels. There are always accidents. Trust me, you think ESG policies are expensive, try an accident. That is far more expensive and very, very disturbing for the individuals involved. And so I would ask you to go with it and treat it as a learning experience. However, I've seen, particularly in Southeast Asia, palm oil. That is something that, instead of saying palm oil is a reality, we should mitigate the risks, we should have clean palm oil, etc., there will be a bias against palm oil. There is indeed a bias against hydropower. Now, there was an example when the Green Climate Fund, a multilateral fund, very much driven by European ideology rather than perhaps pragmatism, made a trip to Nepal. Nepal's power is more than 95% produced by hydropower. It's because it's got fast running rivers. It's a totally clean resource. They're one of the least polluting countries on earth in terms of CO2. And the Green Climate Fund gave a presentation to banks saying, we don't like hydropower. And the bankers walked out. So you've got, there's a meeting of the minds. I think European investors need to have a dose of reality, but also I encourage you seeking that capital to realize that what is meant behind those things is for your good. Additional accountability will make you a better investor or a better company.
Lovely. There's a couple of questions that I'm going to try and merge and ask you. There are two people who are interested in changes in standards, IFC performance standards. Are they more stringent on issues like biodiversity or like what you mentioned, gender equality, etc., that people here should be cognizant about?
Could I invite my colleague Sandeep Shrestha to answer that if the technology permits?
Oh, yes. Oh, yes.
Are you there?
Sandeep, if you can hear us, just unmute.
Yes, hi everyone. So usually the way IFC performance standard works is that it's a guiding principle, it's a framework of they have combined from their learning, and it's a guiding document. So when you are assessing impact, environmental or social for any of the project, it's based on that project reality. So if you're investing in a 30 megawatt hydropower, the risk associated with that is completely different when you're investing in a tech company. So it's a guiding document, it's a principle whereby you follow the standards to identify what kind of risk that particular project or company would have on the environment and the community and the workers. So based on that, you are identifying the risk and implementing the mitigation measures. So yeah, in brief, it's we wouldn't talk about how stringent it is. What we're saying is depending on the company and the project you're working on, some standards or some requirements would be very strict. And in certain cases, these requirements may not exist. There might not be any impact. Yeah, thank you.
Thanks, Sandeep.
Thank you, Sandeep. There is a question, and Tim, we leave it to you whether you'd like to share these information. What is the tariff for a solar plant in Nepal in terms of, let's say, dollar purchase power agreements, duration of these PPAs or such things, and even pricing for debt, etc.? A few of these points we'd like to share.
That's all public information and policy driven. Nepal is doesn't really have an energy market. You can only sell your power to one buyer. It's the Nepal Electricity Authority, owned by the government. The solar tariff is currently 7.3 Nepalese rupees, and the currency is pegged to the Indian rupee, and the Indian rupee has taken a hammering. So I have to look up the conversion rate, but it's probably about 6.3, something like that, US dollars. It does not give US dollar PPAs. It does give some US dollar hedging above plants for 100 megawatts. PPA duration is typically 25 to 30 years. In many ways, having hydropower is similar. It has fixed tariffs depending on the type of hydropower plant. If it's a run of river, that just uses the velocity of the river as opposed to a dam storage, is 8.4 rupees in the dry season, 4.8 in the wet season. And it is actually quite convenient to have these fixed feed-in tariffs as opposed to market. You kind of reverse engineer your project to see if it can be economical to the fixed tariffs, as opposed to here am I trying to figure out the market price over time, which is obviously more complicated.
And here's a question on time frame, Tim. What is the time frame that your company is usually willing to look at to invest in a project before expecting to see some profit? How long for the return of investment that the investors would like to see?
Between 3 and 7 years would be our target. Private equity funds typically are fixed end, closed end funds. So they fit it in our case, which is very common. We are a 10-year fund. We can have an extension of 2 years at the investor's agreement. And so that limits us. So we are sort of a medium-term investor in complex places, by the way, anywhere. It takes a while to add value. We are very hands-on with our companies. We're not sort of passive like perhaps a hedge fund manager just buying stocks and watching the tickers. Very hands-on, especially with things like ESG, because that's where we can add most of the value.
This question should be taken tongue-in-cheek and with humor, Tim. One of the participants notes that the Dolma Himalayan Energy board and advisors and management are not gender-friendly.
That is an excellent point. And that is the case with, unfortunately, many of the, our companies. We perform very well on gender policy relative to the country. We do stop short of quotas. I have been in situations where what I do not want to do, we have in our Dolma Impact Fund team, I think 50% of our team is female. and that's a team of about 20. But the senior managers, probably 2 out of 5 or 6 are females, so more like 30% in the senior management. The rate of promotion, once you implement gender equality and anti-discrimination policies, is very good. We have very much a Western policy. But we do also have a belief that we don't want to belittle the talent of women when they know they are a particular position because they're a woman. We've seen that people lose confidence. I've actually had pushback when I've attempted to do that. And I believe that the incredible female members of our management team are on the way up. I often speak to them. Our senior investment manager is a woman, and I often speak to her in her appraisal about, how do you feel? Nepal is a patriarchal society. You're there probably across the table from a sort of rugged businessman. How do they treat you? And she says, yeah, well, sometimes they, they look at me strangely. She's also quite young. She's, probably, I don't want to get this wrong, about 30. And she says, but that soon goes away when they realize I've got the money. So if you're sitting there with, $5 million sort of rustling in your pocket, any discrimination seems to fly out of the window. So money is a great gender leveler.
Right. There's a few more questions. Very quickly, would getting a FTSE 4 kind of rating be sufficient to attract investors from Europe?
FDIC?
FTSE, this is one of the ratings from the stock exchanges.
I don't know whether it's sufficient. It will certainly help. Being a signatory to UNPRI, FDIC, IFC performance standards compliant, there is many things that will help. I think the point here is what is at the heart of your company's culture, not what letters you have after there is a lot of greenwashing, a lot of impact washing. We do great things, we're environmentally friendly, but when you really get to know the board, the owners, the management team, do they live and breathe the fact that business operates under a charter from society and the environment? And if we ignore those, that will create an unnecessary financial risk for the company. And we know we operate within that charter. Is that the core of your company's being? That's what investors are really looking for.
There are 2 more questions and 2 more minutes, and I'll read out both and I'll let you choose which you'd like to answer. One of the participants would like to know, are there any plans for your foundation to bring your expertise, particularly in AI and high-tech and education, into Malaysia, perhaps via University of Nottingham's offices? But the other question is, any advice for aspiring ESG fund managers, and how do they attract investors in general, especially for ones who are sitting here in Malaysia or even Singapore, for that matter?
If I get time, I'll ask you to repeat that second question.
Sure.
But are there any plans for Dolma Foundation to come into Malaysia? No immediate plans. However, Dolma Foundations is going to receive a share, quite a generous share, of Dolma Impact Fund's carried interest. In other words, the profit share of the fund manager in the fund. Now, we are in our 6th year of 10 years. We've had 1 exit, which was fantastic. We've got 9 investments. We need to exit another 8. And over the next few years, we will know our profit. If we were to be very fortunate with our carried interest and profit with the fund, we will look to expand, especially into AI and education, because I think that building on this 4th industrial revolution concept, never was there a better opportunity to equalize the global economy. It is in fact the Industrial Revolution that caused the inequality. Before the Industrial Revolution, Britain, Asia, Africa was largely the same in terms of economic output. It is the, not through any sort of evil necessarily, but it is that creating the factories and the geographical link between those factories and fixed assets and the economic gain that created the huge inequality we see in the world today. With the internet, the cloud, processing power, and AI, we see the opportunity. Now, if we don't jump on this opportunity, we will lose it. And the only barrier is no longer fixed asset bandwidth processing power, it's education. And so where I would like to see, where I've seen perhaps the most long-term impact in our portfolio are these investments that create online ed tech platforms to bridge that educational gap between local universities and what's needed today in American Silicon Valley firms, for example. So what I would love to, if we have the funds, expand and look into that area. Could you repeat the second question? I'll try to very quickly answer it.
Any advice for the ESG fund managers here to attract investment? General advice.
Yes. Adopt the IFC performance standards or a similar one. Look up what standards and policies they use. Learn about them before you approach them. Be honest about how much you know them. You probably haven't used them. Try to find things you have used and map them onto that. Don't pretend you know them, but be willing to go through a continuous learning process with your investors to reach the standards that they need.
A few minutes over the time. Thank you all to the participants to hanging on, and please stay on for a little while. Tim, the words can never be enough to say thank you to you, how you can distill years of experience, multitude of experience, and bring it across in brevity to the audience. Always a pleasure and a privilege, sir. Thank you very much.
My pleasure.
Thank you, Feroz and the GCMY team, particularly, to put it up, and my colleagues, Bentley. One of the reasons for having this topic is to stimulate even research interest and perhaps getting people interested in such issues. Feroz has started a center of excellence under the Global Compact. The business school here wants to be part of it and get our students to do projects in that area. So I hope this stimulates interest among people and collaborations. With that, Feroz, over to you for the poll.
Thank you, Mohan. Thank you, Tim, for wonderful sharing. I think all of us on the call will probably be energized now to see how we can link ESG to our day-to-day investment decisions as well. Now, before we sign off, we'd just like to run a simple poll. If I could ask everybody on the call to go to menti.com and input this code that is given at the top of the screen, and if you could just answer the questions asked. So as you answer, you will see a live change in this. So let's give maybe a 30 seconds for people to just log in and start answering. Maybe last 5 seconds before we move to the next question. Okay, shall we move on to the next question, please? Right, next. Oh, this is an interesting insight, Mohan. All right, next, please. Next. Okay, let's go to the last question. Okay, that is the last one, right, Shavin?
Yeah.
Right. So, okay, with that, we've come to the end of our webinar. We thank you all for participating, for sharing your insights in the poll session as well. Please do join me for a virtual thank you to applause and thanks to Tim for such great sharing and insights. I am motivated the moment that we can travel. I want to go to Nepal now to see and learn more as well. And hopefully, we can have Tim coming to KL often as well to learn more from him. With that, thank you all very much. Please stay tuned for more webinars that we have planned in our series together with the Nottingham University Business School. And pleasant day ahead. Stay safe. Thank you once again.
And have a good V-Day performance tomorrow, Tim.
Oh, yes. We still have some time if you want to give us a sneak peek.
Unfortunately, we're out of time.
All right. Take care. Thank you again.
Thank
Bye-bye.
you.
Take care, everyone. Bye-bye.